Our first presentation is how CPG brands are budgeting and organizing around e-commerce. Our speaker is Keith Anderson, SVP of Strategy and Insights at Profitero. Keith, take it away.
Thank you, John, and thanks to you and Linda for organizing these events. We're really pleased to be participating again. Good morning, everybody. I'm Keith Anderson. I lead product strategy for Profitero. We're an e-commerce analytics provider to retailers and brands. And today, I'm excited to share with you results from really two studies that we conducted over the summer of 2017, one of which is a refresh of a survey that we first executed in 2016 and updated this year. It was a survey completed by more than 130 brands in 10 countries globally. And some of the things that we wanted to know and we know you want to know are difficult to get answers to without simply asking. And the second study we did was to collect data from LinkedIn about the roles at CPG companies globally that are fully dedicated to e-commerce. And we learned a lot about how many people are in those roles, what their responsibilities are, seniority and experience levels, and much more. And we thought, just given the timing of this event, many of our clients and folks in the industry are either in the throes of the annual budgeting and planning cycle or just completed with it, or certainly looking forward to 2018. So we thought it would be helpful to share some of what we've learned from the industry and from these studies about what ultimately dictates the way that companies actually pursue success in not just the e-commerce channel, but any channel. So today we're going to cover briefly the role of strategy and culture in organizational structure. I think 95% of what I'm going to discuss is really about harder statistics and data, but ultimately, in my experience, there are some intangibles that are really, really challenging to work around if you're not aware of and addressing them. So we'll spend a moment on that. We'll certainly talk about how brands are budgeting and structuring for e-commerce. We surveyed the industry on some of their priorities and challenges as it relates to e-commerce, and I'll share a lot of data on team size, composition, talent profiles, some critical roles that have emerged to support the e-commerce channel, and a brief discussion of the distinction between dedicated versus designated staff to support this or really any other function or discipline. I do want to note these materials are available for download if you email me at keith@profitero.com, and my contact information is on the first slide and the last slide. We actually have an extended data set that's available for different industry segments. So if you're in the pet food segment of the industry or beauty care or grocery or beverage or whatever it is, odds are good that we have data specific to the part of the industry that you're in, and I'm happy to share that if you're interested. So just email me. So let me emphasize some of those intangibles up front, because we've been a part of or exposed to a lot of companies that have actually dedicated significant budget to e-commerce, but still struggled to succeed. And in some cases, we've seen companies that can't find the budget to support what some people strongly believe is a big opportunity, and often that comes down to defining success. And I think you've heard us present on e-commerce specifically related to grocery and CPG products for a few years now through these lead conferences, and I think it's increasingly clear that if a year ago I was telling you we were at an inflection point, we're clearly past the inflection point. Amazon's acquisition of Whole Foods, Walmart acquiring Jet and expanding its own online grocery business, the incredible growth of Instacart, making online grocery accessible in more parts of the country, and the continued growth of longstanding industry incumbents like Peapod and FreshDirect, I think collectively it's very clear there's a lot of growth ahead here. But where we often see companies struggle is defining and aligning around what success in a channel like this means. So I think, probably unsurprisingly, most companies focus first on really specific metrics, which I've bucketed here as sort of hard objectives. And they typically come with KPIs like incrementality, that is, what percentage of what I'm going to sell in this new channel will be net new and additive to what I sell in existing distribution channels. What's the growth rate, and how does that compare to the total retail channel or to my total top line? What's my share of the channel? And that's a really important but really tricky one, especially on a retailer like Amazon. I've seen almost every company I've ever worked with set their fair share as an objective for the e-commerce channel. Fair share simply being whatever their share offline is, they want an equivalent or greater share on Amazon. And the practical reality is that the larger your share offline, the more challenging it is to get your fair share on Amazon. That doesn't apply equally in every online business model, but it certainly is the case at Amazon. And one of my colleagues, Ryan Jepson, published a great two-part series on why small brands tend to outperform on Amazon. And the second part is about how big brands can leverage their scale effectively. So we're not going to cover that today. I just can't pass up mentioning it when it comes to share. And then fourthly, but certainly not least, there's this small issue around profitability. And I think there's no arguing that the economics of e-commerce for both the retailers and for the brands are complicated, both on the top line and the bottom line. Dynamic pricing and price transparency, small order quantities, new supply chain implications. It's a little complicated if you're trying to put e-commerce as a growth channel in the context of your total business when it's growing at such an incredible pace, but as the volume shifts in that direction, it's not clear whether you can maintain your current margins and profit or whether you're going to have to plan for a different scenario. So all of those, I think, are important for every company to discuss and ultimately define what success means. I think what is important, especially for big brands, to respect at the beginning of that discussion, and every time it's revisited, is that there is no guarantee that e-commerce will be incremental at all. And I think we've seen many companies overemphasize incrementality. That's not to say it's not important, and you should absolutely aspire to sell as much online or in any channel that's incremental as possible. But the very real scenario that we've already seen play out in some categories is that the demand is shifting there regardless of whether or not you come along for the ride. And so if you do nothing, the risk is not that you would have shifted volume from one channel to a new, potentially less profitable channel. The risk is that the volume in your category or in the industry at large shifts and you don't shift with it. So you have to think about the downside risk of doing nothing equally or maybe more than you think about the upside potential of doing something. And in fact, as you start to build the business case for pursuing the channel, there's a little psychological effect called loss aversion. And it can actually be more motivational on a personal level to tell somebody what they stand to lose than what they stand to gain. And we've seen brands lose significant share in the total retail channel because they deferred or never pursued growth opportunities like e-commerce and Amazon. All of that said, there are some other, what I think of as soft objectives that are worth considering. There's no question, e-commerce accounts for a couple percent of total grocery and CPG volume sold in 2017, but a much larger share of the growth. But what a lot of companies underemphasize is how influential it is over other retail channels. Product detail pages have become a primary source of product information regardless of whether people are buying online or offline. And study after study from companies like Bloomreach and Forrester emphasize that Amazon is a primary destination for product search and research. And so making sure that you are easily discoverable or findable and that your products are well represented is a big deal, and increasingly so, regardless of whether people are going to buy it online or offline. It's also a pretty powerful way, particularly through ratings and reviews, to turn some of your most loyal shoppers into brand advocates through a form of, in effect, social media that has a much longer half-life than what we often think of as social media, Facebook, Twitter, and so on. Ratings and reviews on e-commerce retailers' product detail pages are there forever. And so if you're thoughtful and proactive about managing, to the extent that you can, ratings or reviews, you can get a lot of leverage out of your existing base of loyal shoppers. And finally, particularly as you think about some of the incumbent brick-and-mortar retailers for whom e-commerce is a large and growing strategic priority, it's almost not optional. They're telling you as suppliers, you must support our omni-channel and e-commerce initiatives. And so to the extent that you value your position as a category captain or a strategic supplier to any of your big brick-and-mortar retailers, and that really covers, food, drug, and mass. I can't think of a single brick-and-mortar retailer for whom this isn't a top 5 priority. This is also part of how you remain in the good graces in the brick-and-mortar world. And culturally, I think, as I said, almost all companies focus primarily on who do we need to hire to lead this, and what should the reporting relationships be, and how many people do we put on each account team, and should they be based at headquarters or out in the field. But very briefly, I just want to reiterate, you will have such a clearer pathway to actually making these decisions and taking action if you have executive, basically C-suite and board level support and endorsement. And so if your company doesn't have somebody on the board that's got some digital native experience, or your C-suite is still heavily skeptical, one of your priorities should be finding a pathway to those leaders and persuading them that the time is not just now, it was years ago. And I think relatedly, everybody in the company, regardless of role or responsibility, needs to understand that they have some role to play here. In other words, this isn't likely to be a small specialized function that sits adjacent to everything that we already do. It in fact is already impacting the way we do category management and shopper marketing and supply chain and sales and everything. And so to the extent that we can get organization-wide awareness and alignment and understanding of that simple point and start creating training programs and development programs and giving everybody across the organization clarity about how they can participate in the shift, the likelier that a company overall is going to succeed. And I think lastly, there's a trend that we've seen in the industry of experimentation for the sake of experimentation. A lot of retailers and suppliers set up venture arms and innovation labs. But if you look retrospectively at all these experiments and then see how many amounted to anything, an actual initiative that passed through the stage gates and was scaled out, at most companies, nothing really happens. And that's not to say there aren't great success stories to come from those, but the reality is the most successful form of experimentation has a hypothesis. And so you've got to go into investments in innovation and emerging channel development with a clear idea of what you're testing and what you're going to do if the test is successful. So experiment by all means, but make sure that there's a hypothesis behind the experimentation. Okay, let's dive into some of these survey results. So these are responses to the survey that we fielded. Again, 134 brands globally from 10 countries in many categories and companies of many scales. But what we heard this year was that almost 40% of respondents said that e-commerce in 2017 they expect will represent between 2% and almost 10% of company sales. And that's generally an increase versus 2016. Actually, a smaller percentage of respondents in 2017 said that e-commerce would represent less than 1%, and a smaller percentage said that it would represent between 1 and 2%. But larger percentages said it would represent between 2 and 4.9 and between 5 and 9.9. So I share that simply because in under a year, not every company publicly reports the share of its sales that are represented by e-commerce, but we saw a very clear shift from the low end of the single-digit share of CPG companies' total sales to the higher end of CPG companies' sales in 2017. And admittedly, it's self-reported, but I think it's reflective of just how quickly this shift is accelerating. We also asked companies what their growth targets were for 2017. We asked the same question in 2016. And here, half of companies in 2017 said that they were targeting growth of more than 25% year over year. And I think in isolation, that sounds really high, but it's also important to add some context. Many of you may have seen Amazon just announce their third quarter results. Their year-over-year growth was actually 34%, so they're outpacing this 25% benchmark. And e-commerce overall is growing in the high teens year over year. So the simple conclusion I reach from some of the responses we got is that CPG companies certainly are setting aggressive targets relative to brick and mortar, but while they didn't give us really precise detail about what their specific target is, they're certainly trying to meet or exceed the pace of e-commerce, but some are actually sandbagging a little bit, I think, relative to Amazon's year-over-year growth. We asked what's the single most important priority as it relates to e-commerce, and some of the options, in addition to an open-ended response field, were establishing a strategy, finding more effective ways to partner with retailers, attributing sales online and offline, or at least attributing the impact of things that we do online, offline, attracting talent, and so on. So a couple things to highlight. Number one, obviously, you can see there was a shift this year towards clarifying strategy, and that's why I spent a few minutes up front on defining success and the importance of culture, because I continue to walk the halls of CPG companies, large and small, where this issue is getting more challenging, not less, and I think a lot of it has to do with a lack of clarity and alignment on those points. I also think, this does not surprise me at all. We only had 3% of respondents last year saying that attracting, developing, and retaining talent was a top priority. This year, it was 10%, which is still not a huge percentage, but when I share some of what we found on LinkedIn and what we see in our own client base, it's very clear that the demand for talent outstrips the supply. I've been working in e-commerce and CPG at the intersection of e-commerce and CPG for 10 years, and I see so many companies trying to hire people that have 5+ years of e-commerce experience in a CPG company, and there's under a few hundred people with that profile that are out there. But the demand for that talent profile is in the thousands. Certainly in the U.S. and the U.K. and a few other developed markets. So there's a huge need to both attract and retain that talent, but there's also a need to really quickly train and develop people that maybe don't have the 3 to 7 years of experience in both CPG and e-commerce, but need to do this work that I'm going to describe. We also asked what was the number one KPI, and I think this ties back directly to defining success through hard objectives and some of those growth targets, but clearly the number one priority in terms of defining success is year-over-year sales growth. And I think that is appropriate given the stage of maturity that we're at. I'm very heartened to see that many companies we work with do focus on profitability really as a medium-term priority. So they're not ignoring overall channel economics altogether, but they understand that we're still sort of in the early innings of e-commerce as it relates to grocery and CPG products, and as a result, a huge focus on growth is really the number one objective. I do still see a lot of companies focusing on market share, and we're not going to go deep into the challenges of measuring market share, but suffice it to say, on a total market level, it's not the easiest thing in the world to do. So I think not only is it challenging to get objective and complete data for all retailers in a given category, given the growth of the channel, it's probably not the right metric to prioritize above all others. It's great data to the extent that it's available, and it can certainly serve as a beacon as you're trying to compare your performance in this channel to other channels. But because of all the distinctions about how growth in this channel is evolving, in other words, the aisle at Amazon is endless, and so it's very hard to get equivalent share at Amazon versus any food, drug, or mass retailer, because you can't just dominate the physical shelf quite as easily. And so, as I hinted, some of the scale-based advantages that CPG companies have really developed for brick-and-mortar retail translate to e-commerce and Amazon specifically, but some don't. So you really need to understand how this channel behaves differently, and that might lead you to think a little differently about how you think about market share. I just mentioned a little bit of the complexity of measurement and reporting, and clearly, we saw a little bit of an improvement in 2017 versus 2016 on that front, but we also saw a big split between large companies and small companies. So on the topic of measuring and reporting specifically. So I did want to spend just a moment on that. I think there are a few things to highlight about why this channel, despite the idea that because it's digital it should be much more measurable than offline, is so challenging. First you have to think about the different types of data that companies want to analyze, and the basic sort of point of sale view of both the market and account level data is not as mature as brick and mortar retail. It took 50 years in essence for all of the retailers to join the cooperatives and pool their transactional data and agree on the guidelines and guardrails for how that could be shared and used. And all that work is happening now, and it's progressing in e-commerce. But some retailers, and notably some of the largest and fastest growing, don't cooperate. And so there are other methodologies like behavioral panels or methodologies like what we do for Amazon that can fill in some of those gaps and give you clarity, but it's not easy to get a complete and granular and accurate view of online the way you are accustomed to getting it from offline. There are also some really interesting and important new data sets. Digital shelf analytics are sort of at the core of what we do, and the elegance of those is they're available for any retailer, and they essentially measure, as you might guess, the digital shelf, what shoppers would see if they were visiting Amazon or Walmart or Jet or any online retailer's site or application. And they represent things that you can measure and impact. Some you can manage really comfortably, some you can merely influence. But the generally better availability of that data, while it's fantastic, it doesn't satisfy the need for the first data set. And then finally, there are just a lot of challenges we hear about aligning some of these new data sets with traditional brick and mortar data sets. Can I look at my categories through the same lens that I look at brick and mortar, and those kinds of questions at the same level of granularity over the same periodization or time intervals. So I think where we would coach anybody listening to start is you certainly want to know what you want to measure based on your strategy, and you certainly want to find the most accurate and comprehensive measurement available. But you're likely to discover that there are different metrics that may not be familiar that are more available, and in many cases are more relevant to the way this channel operates. And the real key is finding someone who can help you parse all the different methodologies and metrics and land on a relatively simple scorecard that is clear, that people at different levels of seniority and in different functions can all look at and understand whether you're on track or not. That simple sort of KPI reporting and scorecarding mentality is in large part what drives the operational model for brands selling through brick and mortar retail. And we see too many companies, as this highlights at the smaller end of the market, really struggling to understand what do I measure and how do I measure it, and then how do I disseminate that across the organization so that we can stay on course. All that said, we certainly see a relationship between this improvement among companies over $500 million in annual sales reporting to us. Measurement is still a challenge, but it's less of a challenge in 2017 than it was in 2016. When we asked, do you work with e-commerce analytics and measurement providers, at the larger end, 2/3 in essence do work with somebody that's helping them keep score and optimize performance. At the lower end of the market, the small and mid-tier companies, it's about 1/3. And I think the only real point to make here is that, as the saying goes, it's very challenging to manage what you don't measure. And so I think one of the scale-based advantages that until recently some of the larger companies have enjoyed is analytics have been available, but they've generally been priced at a level that's inaccessible to a lot of smaller and mid-sized companies. That has changed over the last year or two, and there are sort of right-sized options for companies of every scale and maturity level. And so it's clear that there's some catching up to do for some parts of the industry on that point. Speaking of maturity level, we did survey folks a little bit about where they would self-identify their level of sophistication. And we again saw an interesting divergence between companies large and small, but a much larger percentage of the smaller companies self-identified as novice, really just beginning to organize around e-commerce, and almost half of large companies self-identified as advanced. There's a very small percentage of the industry, both large and small, that self-designates as expert or leader. But as we look at companies large and small and compare results from this year to last year, there clearly is a growing number or percentage rather of large companies that are maturing and consider themselves more sophisticated. But building on the last point, it's increasingly clear to us from these results, despite some of the structural advantages that smaller companies tend to enjoy, they actually don't consider themselves to be as sophisticated or advanced as larger companies. We titled this session How Companies Are Budgeting and Organizing, and budgeting, as many of you might appreciate, is a huge challenge in this channel. To briefly summarize, it's a challenge because it doesn't exactly align with the way many CPG companies budget for offline retail. In other words, we have brand dollars, we have trade dollars, and national campaigns tend to go through brand budgets, and retailer-specific stuff comes through trade or shopper marketing, and so on. Part of the complexity, especially when you look at a retailer, or rather a company like Amazon, that is a retailer but also runs a large national digital display network, it's really hard to classify a company like Amazon as a retailer or a media company or any one thing. And consequently, Amazon is going after every budget. They want brand dollars, they want trade dollars, they want shopper marketing dollars, and all these concerns about fair and equitable trade practices continue to swirl around the way many companies are planning their budgets. So we didn't ask what the right way to do it is, but we did ask, how do you do it? And when you segment companies based on how they self-identified their sophistication, and then what the primary source of funding is, interestingly, you don't see wild divergence. What you do see is marketing is by a small margin the number one source of funding, with sales a close second, basically at all tiers of sophistication. What I was sort of surprised by was, you do see a large and larger than we saw last year bucket for e-commerce as a standalone line item. So I think we do see companies for whom e-commerce does not yet have its own dedicated budget, and that does seem to be an enabler of agility and responsiveness, so that you're not necessarily running decisions that are the right thing for this channel through a committee, or having to basically zero base your budget and argue against colleagues or peers that they need to give money up in order for you to get money to do what you know is right. So this will remain, I predict, a huge challenge, because a lot of the definitions and guidelines about how budgets should be defined and allocated for brick and mortar just don't work for e-commerce. And until we as an industry figure out how to redraw the boundaries, I think it's going to be a big open question. I want to transition now to a little bit of discussion about how companies are organizing. And briefly, I'll talk a little bit about organizational structures and how they're evolving. This is not a single ideal or optimal organizational structure, but it gives me a way to talk about some of what we see. The very first question most companies ask is, to whom should e-commerce report? And in about 3/4 of companies, from what we can see, it reports to sales with a dotted line into marketing. There are arguments for both sides. I think those softer definitions of success, brand equity and offline influence, I tend to see those emphasized more at companies in which e-commerce reports directly to marketing, and I tend to see more of a focus on harder objectives like sales growth and incrementality and market share and even profitability in companies to whom in which it reports to sales. Then I think a huge majority of the industry now has an executive at either or both of the global and country levels who is a general manager, vice president, or director of e-commerce. There's data in here about how prevalent that role is. And then they tend to directly oversee, in many companies, pure play account teams. That is a team or an individual that would support retailers that don't have a brick and mortar presence. Although Amazon bought Whole Foods, and the Amazon team usually does report directly into e-commerce. Then, of course, you've got brick and mortar teams who have, in many cases, individuals that are designated to e-commerce. And so the distinction between dedicated and designated is simply somebody who's dedicated to a given function does nothing else. Somebody who's designated does a lot of other things and whatever they've been designated to do. And in all of our interaction with clients and prospects, our simple observation is people who are designated to e-commerce or anything really tend to be less accountable and committed simply because they have too much on their plate. And if they have 4 responsibilities and e-commerce really only represents 5 or 10% of how their success is defined, it only gets 5 or 10% of their effort. Finally, there are some roles here that I'm going to discuss in more detail, some of which are emerging roles that you may not have heard of, but I'm going to show you descriptions of those roles because they're increasingly essential to the way that companies are actually managing and executing in this channel. Briefly, though, I just want to characterize the types of people that are being hired for these VP, General Manager, and Director of e-commerce roles. I think the ideal profile is somebody who's done exactly that job, but as I emphasized, there's not more than 100 or so people in the industry at the executive level that fit that profile. So as an alternative, there are folks who have a lot of comfort with ambiguity. They've got prior experience in pioneering roles, basically discovering what the work is, defining and structuring the work, defining success, and then building workflows and work streams to get it done. But the most important thing that I want to emphasize, and I'll let you read the slide yourself, is the importance of having someone in that role that's internally credible and can translate across functions and can help make the unfamiliarity of this new channel familiar to people who spent their whole careers in brick and mortar supply chain or traditional marketing or traditional brick and mortar account management. Because I would argue the first 12 to 18 months in a VP of e-commerce role is going to be dedicated 50% to internal education and consensus building, that we're doing this and here's why and here's how we're going to do it and here's how you can help us win. So one pitfall is hiring somebody who comes from one of the FANG companies. Hire somebody from Facebook or Amazon or Google or Netflix or wherever who's a digital native but doesn't know the vocabulary or the concepts or the context of CPG. And they don't get anywhere because they can't explain or persuade any of their peers or superiors what to do or how to do it. So we looked both in our survey and in our LinkedIn study at account level dedicated support. And I think what's really clear is Amazon certainly is the single account that gets the most dedicated support. Almost 2/3 of accounts in 2017 or survey respondents said that they've got an individual or a team dedicated to Amazon. I was candidly surprised not to see a bigger shift this year versus last year for Walmart. I suspect when we do this study next year, you will see that number go up. But this to me underscores, again, the point around dedicated versus designated. It's a strong sign to me that there's commitment to supporting this work at the account level when I see that there's a lead or a team that's dedicated to the work. I mentioned this phenomenon of companies hiring from Amazon, and in our LinkedIn study, we found that 17% of U.S. companies have hired somebody from Amazon. And then we decompose that by role, and you can sort of see, a lot of them actually fall into supply chain, and a meaningful percentage are in channel management roles. So this is a common phenomenon that happened in brick and mortar retail as well. When there's a key new retailer that you need to understand and accelerate your performance with, what better way to ramp up quickly than hire people that have experience at that retailer. But it's still a minority of the industry that's hired those folks. We also looked at, for these account management roles, specifically for Amazon and Walmart, where are they located? There's a lot of interest in whether, as was the case in brick and mortar retail, whether account teams can be more successful if they're co-located at the retailer's headquarter location. Does that translate to e-commerce? And 70% of Amazon and Walmart account leads are headquartered at their own corporate headquarters, not in the field. 30% are in the field. But when you look at the e-commerce dedicated account managers that are in the field, 2/3 are associated with Amazon. So in other words, those are people that are in Seattle. So the short takeaway is only 1/3 of dedicated e-commerce account managers are in the field, but of that third, 2/3 are in Seattle supporting Amazon. And anecdotally, we do hear that while Amazon is really a platform and it's better managed through algorithms and automation than through relationship building, simply being close to the action does immerse those teams in the day-to-day developments of a very fast-changing retailer, and it also helps build a network of industry peers that are facing the same challenges and pursuing the same opportunities. Okay, now I'd like to simply read every number on this slide. I'm just kidding. We don't have time. But I included this so that when you download it, you can see some of the detail. This is simply a summary in columns by industry segment, and then in each row, the number of people we found in each individual role. And in an appendix that you'll get if you email me for the full deck, we define each role. We tell you the average seniority level and years of experience and much more. But most importantly, we explain what they actually do. So what I really wanted to do in the time I have today is just highlight a few of these roles that are emerging that you may not have heard of. One role is in this area called content and digital merchandising. And as you've heard me say on past presentations, and again today, at the digital shelf, your content is your packaging. So images, titles, descriptions, feature bullets, videos, all of that is not only important to how you turn up in search results, but it has a big impact on conversion rates. And if you just think about the complexity of, say you have a portfolio of 600 SKUs, and they're changing over, maybe once a year as you update physical packaging or you're launching new items or retiring old items. And you've got online distribution at even just 5 retailers, each with their own content specifications and system for receiving content from suppliers. It's very evident very quickly that this is a lot of work and it's complex work. And so we've seen among the industry leaders the emergence of these roles with titles like digital merchandiser, click and mortar, or e-content lead. And you can read here exactly what they're doing. They are using data and analytics to identify issues and opportunities, and then they're responsible for going and fixing some of those issues at a brand, a category, or an account level. We tend to see these folks aligned with specific accounts, given the nuance between one retailer and the next. But this really is reflective to us of an acknowledgement that content really matters and executing excellently really matters, and dedicating people to that work helps ensure that it gets done and done correctly. Obviously, analytics are a big deal in any distribution channel, but as we've said about content, we see more and more companies dedicating people to analyzing either account level sales and other data, or category or brand. And these are just a few role descriptions of people in analytics roles dedicated to the channel. Supply chain and logistics and customer service, I think, are also just so essential. And this is not yet as widespread as the content or the analytics roles, but I do want to highlight the distinction between these different roles that you see on this slide. Some of these, like this R&D manager role, I think is so important, because that's really about developing price pack architecture and NPD that's optimized for the e-commerce channel, and maybe even specifically Amazon. Both from a sort of demand point of view, is what we're actually distributing in this channel, what shoppers want to buy this way. But importantly, we mentioned a path to profitability. We could and we have done 60-minute sessions on item level economics for Amazon and the e-commerce channel. And a lot of it comes down to the product form and the pack configuration and the overall price pack architecture. And industry leaders are starting to dedicate people to figuring that out. Then, of course, you have all the basic, collaborative forecasting and replenishment work, and basically ensuring that on-shelf availability is maximized and that you're delivering the right supply on schedule and minimizing deductions and other supply chain issues. So again, that's a logical evolution of the channel. And I'm looking at the clock, and it looks like we're close to the end of our time, and we're also close to the end of the presentation. So just to briefly summarize, we talked a lot today about defining success and how companies are budgeting and who they're hiring and the kinds of roles they're putting people into. I think one important sort of maxim every company needs to remember is all of this structure stuff follows strategy. And since strategy is in my title, I get a little unnerved when people say culture eats strategy for breakfast. But when it comes down to what actually gets done, it's true. So I think when you're going through budgeting and planning and trying to secure the budget to hire the right people or put the right tools in place, I do always emphasize not losing track of these overarching essential considerations, like making sure that the whole company knows how we're defining success and making sure that culturally we're aligned with that definition of success and everybody feels some ownership and involvement. I think as you see both from the survey responses and our LinkedIn data, measurement and analytics are a challenge, but important to focus on, especially as it relates to that first point. If you define success but you can't measure it, it's very hard to stay on track or make progress. And then finally, I think it's clear as this channel is getting more important and budgets are growing and commitment is growing, there is an increase in dedicated and specialized staff for the channel and at the account level. And I think as you look at data like ours and try to benchmark where you are versus competition, you will increasingly see the leaders in the industry are dedicating people in specialist roles to ensure that the important work gets done at the right level. So that's it for me. I really appreciate everybody joining us today. There's my email address again in case you'd like to receive the slides, including some of the more detailed data in the appendix. And I'll hand it back to John to see if there's time for any questions.
Okay, we just have one question, Keith. What do small companies do better than big companies?
Gotcha. Well, I think, interestingly, when you look at what they told us, they consider themselves less sophisticated, and they seem to have more challenges in areas like measurement and analytics. That said, I think the single biggest advantage they have is alignment and clarity about what success is, and it usually can be summarized as growth and being on offense. I think new brands or smaller companies that don't already have widespread brick and mortar distribution, they're not a number 1, 2, or 3 share leader in the category across all channels. They look at e-commerce and Amazon specifically as maybe the fastest pathway to national awareness and distribution. And consequently, they don't spend a lot of time in committee debating, should we do business on Amazon, and should we learn how to optimize their search algorithm, and should we figure out the most effective promotional strategies? Should we invest in more and better product content, and do we want to run some sampling campaigns to boost our review count? They just go. And, we look at data, sales and share data for so many categories, and there are always unfamiliar names in that top 5 sort of share leader position on Amazon. And when you unpack what they're doing, they're doing stuff that any brand or manufacturer could do. They're just doing it sooner and better. And when I talk to them, it usually comes down to they face less internal headwinds. They don't have to consider the downside risk of alienating the club channel or one of the mass players or anybody else. They're fully on offense. And so that's not an easy thing for big brands to overcome, and nor necessarily should it be. You do have to balance your existing business with a growth opportunity. But I think there are lessons that can be applied from the way new and emerging brands aggressively pursue growth, really when it comes to execution, that can definitely be reapplied to some of the larger brands in the industry.
Okay, thank you, Keith. If you have further questions from the audience, you can direct them to keith@profitero.com. Excellent job, Keith. Thank you.